Hey everybody, Marty Mazur, the 11th of August 2016, your Thursday video. I'm going to just keep you hopefully just a couple of minutes today. Wanted to make just a couple of points that have to do with what we call rotation in the market and what I view as something that I think tells a pretty decent story of late. What you're looking at in front of you is the ratio between XLK, which is the ETF that tracks the technology sector within the S&P 500, its performance relative to the S&P 500 itself. So I'm going to take you through the 10 major sectors and talk about what's been going on a relative basis. So as you can see lately, and this is a year-to-date chart, the technology sector has really been taking off relative to what's been going on in the S&P. When this number moves up, it's outperforming the broader market. When it's moving down, it's underperforming. Now, technology, of course, being very sensitive to the economy. When we see technology rally relative to the broader market, that says good things, or that's the market saying good things about the economy going forward. Same could be said about the industrial sector. Industrial does have a lot of global reach, as does technology as well. And as you can see, we had a nice start to the year on a relative basis, and pretty much sideways, kind of trading with the index, give or take, in a given day. And then lately, that's begun to turn a little higher as well. Consumer discretionaries, your Starbucks, your Amazon.coms, and so forth, all over the place this year. Just very recently, in the month of August, a very noticeable outperformance relative to the broader market. This would be materials. As you can see, a nice start as commodities began to come back, waning just a bit here lately. The energy sector, of course, energy prices have been all over the place this year. You're going to generally see this outperform as energy or as oil prices strengthen. As they wane, the opposite. And as you can see here of late, there's been a pretty good relative performance for energy stocks. The global natural resources, of course, these are more than just U.S. companies, but this is a ratio to the S&P 500. Commodities have come back. This has been one of our better funds on a year-to-date basis, and more recently, just a slight outperformance for where we are right now in the month of August. And then we have financials, a very economically sensitive sector. Tough time for financials. As you can see, really a rough year on a relative basis. They've had a really nice run, kind of off that Brexit bottom, if you will, off a little bit of late. Financials seem to be extremely sensitive to prospects for the Fed to raise interest rates. So if the GDP now from the Atlanta Fed is correct, and we're going to grow it at more than 3% in the current quarter, you're going to start seeing more talk of perhaps a December Fed rate hike, and that should bode well for financials. I like the sector very much longer term. I like the valuations here. Obviously, not everybody likes it. And since the Brexit bottom, though, financials have turned in a nice relative performance. But it's been tough sledding, and it probably will be for a while. Okay, so healthcare, a more defensive sector. This tends to be a place where people run when the economy is not doing so well, and you can see it's been performing relatively poorly, certainly to start the year, and it's about even on the year, while of course the major averages are now nicely positive. Excuse me. So healthcare is not showing a lot of confidence for the sector itself, but that does suggest confidence about the broader economy when it doesn't do as great on a relative basis. Consumer staples, again, when we had economic concerns coming into the year, of course, staples really outperformed the S&P 500, but as you can see of late, it's really noticeably underperformed. That rotation from staples, from healthcare, and from utilities, which have really underperformed of late, and they've been huge performers last year or two, does say what I believe to be pretty good things about the prospects for the economy going forward. The market is supposed to be a discounting mechanism and give us an idea of what we have in store. Doesn't mean it's right, of course. Doesn't mean that this just isn't some blip in a longer term kind of a nauseated sideways trend, but as I've discussed with you of late or presented to you of late, we're looking at a market that has some pretty nice momentum and potentially has some pretty nice support under the current levels, but I do expect, of course, a lot of volatility in both directions as we move toward the end of the year. Just one more chart I want to show you. I've been talking a lot lately about international investing. I've illustrated for you how the last 7 years we've had this period, a very long period of U.S. outperformance. So this takes us back to the Brexit bottom. Blue line is emerging markets. The orange line is Europe, Australia, and the Far East Index. We'll call it non-US developed markets, and then the S&P 500. So as you can see, over the past month, almost month and a half, we've had a change in leadership. Now, a month and a half does not a new trend make, but this is going to help the relative portfolio or relative performance of our client portfolios, because we do have a very global theme to our portfolios. There's more U.S. than the others, but we definitely have exposure to other parts of the world. And as I've been expressing at every opportunity I get of late, I think the setup is pretty good. So in the near term, that seems to be coming true. Let's just take a peek on a year-to-date basis. On a year-to-date basis, we have emerging markets now in first place. The S&P 500 U.S. markets are running right in the middle, or the upper middle, if you will, and trailing are the developed markets, although we've seen, as I just showed you, if you take a 1 month look, we've seen an outperformance of the non-US versus US. For what it's worth, folks, I'll just leave it there. Thank you, as always, for watching and listening. Look for the weekend update in the next day or so, and I'll talk to you again very soon. Take care.